Let's talk about installment agreements now. Okay. AKA payment plans. That's where you're going to pay a portion of what you owe. You're going to pay what you owe, sometimes fully pay what you owe, sometimes partially pay what you owe, but you're paying it over time. It's not going to be one lump sum payment. Okay. All right. So with that, there you go. So with this, once your request is being reviewed, then the notice is stopped. Okay, the collection notice is stopped, which is good. Who wants to get those notices from the IRS, right? So those notices will stop while it's being reviewed, and of course, when it's approved, you won't get the notices either. So most people, I'd say an overwhelming percentage of people will qualify for some sort of installment agreement. It's just a matter of figuring out which option fits your situation best. So most cases I've worked, the go-to option has been the installment agreement. Okay. So I once had a client, we call him Mr. A. He's a realtor friend of mine. He was struggling to take care of his kids. Yes, he was working. With realtors, sometimes the money is sporadic. It's not, coming in, at an even clip. So he couldn't pay. He just couldn't pay the full amount, right? So we got him on what's called a tiered installment agreement, which is where he paid a certain amount in the beginning, a smaller amount, and then as time goes by, he would have to pay more. Okay, so let's say he was paying $1. You pay $1 for a year, and then by year 2 or year 3, he would start paying $5 or $3 or whatever. So that's the way. That's why, again, I'm telling you that there are various types of installment agreements. Some that are more common than others, but the IRS would like for you to full pay the debt, even in an installment agreement, and they give you a certain amount of time, and it's usually within their window to collect. Okay, so that's why when you owe money and you owe for a lot of years, assuming you file those returns on time, they will apply whatever you pay them to the oldest year, because that oldest year is about to expire. It's going to expire sooner than the newest year, if you get what I'm saying. So no collection activity while you're paying on it. So while you're paying, they're not looking to collect, because they're already collecting. You're already paying them voluntarily, based on this agreement. Under certain conditions, you could have liens removed, depending on how much you owe and that sort of thing. Certain thresholds. Once you meet those conditions, we can request that no liens be filed. Okay. Things like having automatic payments going to them, having them take the money from your account. There are different factors that will play into the potential for removing a lien or not having a lien put in place in the first place. Potential automatic penalty reduction. So you may have heard of, there are two options with penalty abatements, and that's where you have a first-time abatement of penalty, which it sounds, to most people, very straightforward, but it's kind of nuanced. And then there's the reasonable cause abatement of penalty. Okay, so that's where you have to show a reasonable cause, and there's guidance on what's reasonable cause, and we will definitely walk you through or walk through your situation to see if you will qualify for those. And so seasonal adjustments if necessary on those installment agreements. But as I said, remember I mentioned about a tiered, so that could be a seasonal adjustment, if you will. And you may not have to full pay the entire thing. So depending on, again, there's something called a partial pay installment agreement, which almost pretty much guarantees you won't full pay the entire thing, but you have to qualify for that too. Okay. So yeah, everything comes down to what the financials show, what your reasonable collection potential is, what the difference between how much you make and how much you spend. And again, when I say spend, it doesn't mean frivolous spending. We're talking about certain guidelines the IRS has set up for housing and utilities, for food and clothing. There are certain standards that they'll have that you have to abide by. So, with a car, for example, you can't buy a lavish car. You can buy it. It's just that they're gonna not consider that an expense in full. So, again, so your financials are really, really powerful when it comes to resolving your tax problem. Okay. Setup fees for installment agreements, just so you know, is about $205. Same thing for offer and compromise when we get to that. But some of the downsides to installment agreements, setup fee, mentioned that before, 205. They may need extensive and invasive financial information. Okay, we're talking about how much you spend on toilet paper, you name it, feminine products. They want to know everything. Okay, mandatory monthly payments, that's a given. If you don't make the payments, you run the risk of defaulting the payment plan, and then you have to start over from scratch. Okay, and if you hired someone to do it for you, then imagine hiring that person again and paying them to do it for you the second time. That's not going to be a situation you want to be in. So you want to make sure once you get this payment plan or any type of workout option with the IRS or state for that matter, make sure that you abide by the terms of the agreement. And one term of the agreement is you have to make those mandatory payments on time. And you also have to file your tax returns on time. So those are some of the things that some of the rules. So if you don't abide by those rules, you could get yourself in some serious problems. Penalties and interest still accrue under this option. And you may have to keep paying. Some people, depending on their income, they have to full pay over the life of the expiration statute. Okay, so that's that. As I said before, there are many types of installment agreements. I'm not going to go through all of these. It's a class on its own. There's the guaranteed installment agreement, streamlined, as I mentioned before, in business trust fund. I didn't talk about that one. So trust fund is for businesses, right? So when you collect employment taxes, Social Security, Medicare from people, you're holding that in trust for the government. You're supposed to fork it over to them. If you don't do it, you may have a trust fund issue. So if you have a trust fund issue where you haven't forked the money over to the IRS, most of the IRS, it could be state as well, then I'm thinking sales tax, for example. But in that case, then you would have to get yourself on an installment agreement, right? And pay that money back over time. Okay. And there's a regular installment agreement. There's a regular installment agreement as well. And the difference is the regular one is over $25,000, whereas the in-business trust fund express, that's what it's called in reality, that one is where you owe $25,000 or less. Okay. Okay. Types of installment. So there are some more types. Again, I'm not going to go into detail with these, just know that they exist. I think I talked a little bit about a partial pay installment agreement. There's the regular installment agreement, which is you owe it and you have to pay it off in full over time, essentially, because maybe your financial situation, you make so much money that it's just not going to work for you to get any other. So they can be done in conjunction with a direct debit. Direct debit. So basically, if you do a direct debit, in some instances, the IRS will not put a lien on your property. So that's one of the criteria. You have to be on direct debit for them not to do that. They have to be able to guarantee that they're going to get the money every month. That's really what that is. Well, although being on direct debit, you could change your account, all kinds of things could happen, but essentially that they're working that you're going to be acting in good faith. So direct debit definitely would work for you. And yeah, I mean, if you think about it, if you're on direct debit and you're taking money for, as long as you have the money in the account, chances of you defaulting the payment plan is lower or lessened somewhat. Okay. Pending status provides protection. So yeah, while they're looking at while they're looking at your offer, while they're looking at your installment agreement, they suspend collection, right? So they suspend collection. So whilst in pending status, they're not looking to collect from at that point in time. So when they're reviewing everything, once everything is done and being reviewed and you agree to whatever terms, then they start collecting. Okay. So to request an installment agreement, you have to provide identifying information like your name, your social security number, date of birth, and that sort of thing. You have to make sure, you definitely want to make sure you include all the years you owe money, because you don't want to have to modify an installment agreement. It's a pain in the butt. You don't want to have to call someone like me to modify that for you, because I'm gonna have to charge a fee to do that. So it's best to, like, let's say you owe money now. We're in the 2020, the IRS has started to process 2023 returns now. So if you suspect you owe for 2023, it doesn't make sense to it unless there's some exigent circumstances. It most likely would make sense for you to wait to file your 2023. If you can, we'll ask for an extension from the IRS to wait until you prepare your 2023 to see what that looks like, and then just make a payment plan for the entire amount, including 2023. Okay. You can propose your payment terms. You can say, I want to start small and get big over time in terms of the payment, and that sort of thing. So there are different ways to skin the cat, if you will. And you have to have no unfiled returns. The unfiled returns, I kind of like alluded to that earlier. If you have a 2023 return that needs to be filed, you probably should file for more than one reasons. If the IRS, it takes time for them to review the package and assign the case to someone. It could be a year before your case is settled, especially post-COVID. During COVID, it was really bad, but now it's gotten better, but it's still not quite where it was before. It usually would take 6 to 8 months. Now it's taking more like a year. So within that period of time, let's say you had submitted an offer, or I keep saying offer, payment plan today. All right, it may take them till March, April to assign someone to it. Well, by then, what would have happened? You'd have filed your 2023 return, and if you owed money, now you're in the situation where you have to modify it to include this new tax debt. So that's why I'm saying no unfiled returns, file them as soon as possible to get everything under one umbrella, and then plus it looks good on you, right? That you're trying to be compliant, or you're trying to be compliant with the rules by filing on time and by paying whatever. If you can pay what you owe for 2023, let's say in this example, then you'd have that's one less year you have to worry about. Then you're still working with the payment plan for the prior 2 years. Okay. So that's so if you're self-employed, you want to make estimated tax payments for the current year, and because there's a look back period or whatever, so you want to make sure you make those estimated payments. Let's talk about negotiating the installment agreement. Remember, you must be up to date with all tax returns and current estimated tax payments, right? So I mentioned it earlier in this prior slide. You can request an IE by mail, fax, voicemail. I mean, you can do it by phone. Voicemail is not the right word to use there, but you can do it by phone. I've never faxed one in, but it can be done with the agent on the line. They say fax on paperwork, you fax it to them, great. Or you can mail it. Okay. So I typically try to do it over the phone to get it over with, but I've mailed them as well. Okay. Now, one thing I want to mention to you guys is most software packages, if you're preparing your return yourself, you see a form 9465. What's that form? Well, that form will allow you to set up a payment plan on your own. As professionals, we typically don't use that form to prepare an installment or make a request for an installment agreement. It's just that it's not very flexible. And you're kind of limited as to what you can do with that form. So we don't use that. Okay. But it can be done. It can be used. If you like a couple of $100 or something, you could set it up on your own by preparing that form. But again, if it's something that's sizable, the debt, you want to consult a professional to see how we can help. If it's a couple of $100, knock yourself out. Okay. More about the negotiating. You must use it. You must be up to date when all tax returns and current year tax estimated tax payments. I keep saying because it's really important. Okay, that you do this. You request an installment agreement by mail, fax, or phone, not voicemail. IRS form 9465. I mentioned that before. We never use that. Okay. Now you request the specific type of installment agreement that you want. Okay. I mean, it doesn't have to be approved, but you can make the request. You can ask the IRS for anything you want. It's better to ask and be told no than not to have tried at all, right? So that's really important. Okay. I feel like I talked about that slide already, but it's okay. Repetition is good. Let's talk more about installment agreements. Trust fund recovery penalty or ACED waiver. Never sign any forms from the IRS collections without advice from an expert. In fact, never sign any IRS form when it comes to deal with a collection agent or a revenue agent or an audit agent or an audit staff. You don't want to do that. Okay. You want to speak to an expert first before you do that. Okay. Because you may be signing away something that you don't want to ultimately comes back to haunt you in the long run. Okay. So trust fund penalties, as I said before, it's assessed when an individual is responsible to collect and does collect or doesn't collect, and willfully fails to collect or remit monies to the government. Okay. So you never want to sign form 2750 because you may be putting yourself in a bind. Because depending on the assessment statutory expiration date, when they assess the tax, that might not be the best option for you, frankly. So be ready with necessary financials. You may or may not need to provide various supporting documentation. You may or may not be required to apply for loans against property. So basically if you have property, if you have, let's say, real property, a house or something, and it's your primary residence, they may ask you to, if you have equity in the house, they may ask you to tap the equity. They may ask you to try to get a loan. And what we've seen is in some instances, people don't qualify for loans, but you have to prove it to the IRS. You have to show them that you don't qualify for the loan, but you have to try. Depending on the amount of money you owe and that sort of thing, it may be a better option for you. I mean, to be honest with you, the terms on the loans that you get, on a refinance or something are going to be probably better than the interest and penalties you're paying to the IRS. So it's probably better to do that. But again, talk to a financial expert in this field. Okay, talk to someone like myself to see what the best options are for you. But either way, you have to provide the supporting documentation to them and include all tax types and periods. Again, that comes up. It's one of those pervasive things. You don't want to leave out any tax years when you're trying to work something out with the IRS, because you may have to modify that and it may end up costing you more.